Well, hi guys, welcome to this Money Control live stream. You're watching Opening Bell with me, Nandita Khemka. A brand new week, and of course, we are starting above that psychological level of 22,000 on the index. But if you look at the global cues, they are fairly positive. However, the GIFT Nifty is hinting at a mildly negative start for our markets. The implied open was lower by about 40 points or thereabouts. So 22,000, a crucial level to watch out for on the index. Last week, of course, we saw a 2% cut on the benchmark indices for the broader end of the markets, some correction of 4 to 5% on the mid and small caps. So yes, we have seen correction. It has been a roller coaster ride as we are navigating the election season. So 4th June will be a key date to watch out for. Ahead of that, experts believe that we could be grappling with a fair bit of volatility in the stock markets. But of course, lots to watch out for over the next 40 minutes or so. We will be getting all your stock related queries answered by experts as well. So if you have any queries, keep them coming in on our live feed on YouTube. We'll try and get them addressed. A new listing as well today, Indegene. Of course, we'll be taking stock of that as well. But of course, before we move any further, let's take a look at the top headlines at this hour. Wall Street clocks its best week for 2024 with the Dow ending higher for the 8th straight day. Asian markets meanwhile are trading mixed with the GIFT Nifty hinting at a lower start for the Indian market. Brent slips below the $83 a barrel mark amid prospects of lower interest rates in the United States. Gold meanwhile gains about 1% as US jobs data raises prospects of rate cuts sometime in September. Tata Motors reports a mixed bag in the fourth quarter. Revenue meets estimates but margin misses the mark. The management projects a muted outlook in the conference call. Meanwhile, Eicher Motors delivers an operationally strong Q4 with margin coming in at multi-quarter highs. And CPI inflation for the month of April is expected to come in slightly lower at 4.81% vis-a-vis 4.85% in March. So a little bit of cool off in the inflation figures could be expected. And polling for the fourth phase of the general election gets underway in 96 seats across 10 states and union territories. Voting is also underway for 175 assembly seats in Andhra Pradesh. All right, somewhere around 12 minutes to go for the market open. Let's take a look at the cues we are getting this morning. Of course, as I mentioned, GIFT Nifty hinting at a lower start. Benchmarks, meanwhile, last week logged their worst weekly loss in 2 months. Both the Nifty and Sensex shed somewhere around 2% apiece. In fact, the Nifty spot managed to hold on to that 22,000 mark. It ended higher by about 0.5% on Friday. India VIX, this deserves mention, of course, closed at 18.5, up another 1.5%. In fact, India VIX last week jumped somewhere around 26%, and in the last 12 sessions, we've seen an 81% bump up in the India VIX index. In terms of FNOQs for the May series, the Nifty open interest was down nearly 4%, on Friday, shed somewhere around 4.52 lakh shares. The Nifty May futures is trading at a premium of 118 points vis-a-vis a premium of 91.35 points in the previous session. Nifty Bank open interest also was down somewhere around 1%, shed somewhere around 24,420 shares. Option queues, if you look at the put call ratio, it was at 0.91 vis-a-vis 0.9% in the previous session. And when you talk about stocks in ban, the new stock that has entered the FNO ban list is Hindustan Copper. And still in ban, we have quite a few stocks, including SAIL, GMR Airports, Balrampur Chini, Vodafone Idea, PNB as well as Z. Out of ban, we are looking at 2 stocks, Aditya Birla Fashion as well as Piramal Enterprises. So these 2 stocks will see quite a bit of action today, given the fact that they have exited the FNO ban list. FIIs remain net sellers. In fact, months to date, FIIs have sold nearly 25,000 crore rupees. In Friday's session in particular, they have withdrawn somewhere around 2,100 crore rupees worth of shares in the cash market. DI buying support keeps, is coming in as well. Of course, DI has bought somewhere around 2,700 crore worth of stocks in the cash market. So we have seen sell-off when it comes to foreign money, but at the same time, we have seen a lot of buying support come in from domestic investors. On that note, let me bring on board, our guest for today, technical guest. Okay, so he will be joining us in a bit. But in terms of earnings that came in post-market hours, On Friday, we had Tata Motors reporting a net profit at 17,400 crore rupees vis-a-vis 5,407 crore rupees on a YOY basis. Of course, on the face of it, it looks like a big beat. However, there was a tax credit of 8,100 crore rupees, vis-a-vis 621 crore rupees on a YOY basis. So, on the back of this tax credit, we saw a very sharp bump up in the profit. As a result, the profit has been above estimates. Revenue was up somewhere around 14% at 1.2 lakh crore rupees. In fact, it has met estimates. EBITDA was below estimates, up 33%, and margins, margins have been below estimates, 14.2% vis-a-vis 12.1%. If you look at what the brokerages really have to say, JP Morgan has retained its overweight rating on the stock. Target price has been raised to 1115 rupees from the current 1050 rupees per share. It believes that Q4 has come in line with estimates, but free cash flow has topped expectations as well as guidance. In fact, management has maintained guidance of turning net cash positive in JLR by FY25 end, and JLR's FY25 EBIT guidance is around FY24 level. So this is a big disappointment. The margin guidance for EBIT margin guidance for JLR for FY25 is flattish, and this could come as a disappointment, and we'll have to see how the stock really opens. On the back of this, we could see some bit of weakness in share prices as well. JP Morgan also says that market would hope for a repeat of FY24. In FY24, JLR had started with a guidance of somewhere around less than 6% and upgraded it during the year to 8% and achieved 8.5%. So street will be hoping that JLR could be that the company would be doing something similar in FY25 as well. That's according to JP Morgan. For JLR in particular, revenues were up 10.5% on a YOY basis, while margins came in at 16.3%, vis-a-vis 14.8%. Let's touch base with our guest on that note. Let's see if he is joining us now. Prashant, Sawant-Founder at Catalyst Wealth on the technical side. Great to have you on the show, Prashant. Recent swing low of 21,932 that was made last week. Is there a risk of taking that out this week? Would you say that, or would you say that this week, according to the charts, we could trade with some positive bias on the charts?
Very good morning, Nandita, and good morning to all the viewers. So I think I'll talk about Nifty first and then about Bank Nifty. The swing low that was formed somewhere around 20th of April, 19th or 20th, approximately around 21,750 spot levels, is a very, very crucial level going forward for the entire week, considering that we are now at a week of around 18, 19, and it is expected to go up further. So I think for the current week, this low of 21,750 is extremely important. If it holds, we can comfortably see a pullback to the 20 moving average, which is approximately 22,400, 22,350. But overall, my suggestion to everyone would be, considering the volatility and considering the we are seeing, since the VIX is around 18.5, 19, it is very normal to see swings around 200 points within a day on both the sides, 100 points. So your stop losses might be triggered. So the best way is to avoid a positional view on the indices and to keep small stop losses and have an intraday approach if you are specifically trading the index. As far as stocks and sectors are concerned, they are a different story. You can definitely align to the sectors which are performing well, like autos and metals, and choose the stronger ones among them. Whereas you can stay away from something like an FMCG, which is just picking up, but still not showing the conviction and the strength that is required. So for Nifty, going ahead for the week, 21,750 is an important support level. And as far as resistance is concerned, 22,400 holds a lot of importance. If we do happen to see a close above 22,400, I think we might straight rally another 400 points and see 22,800 as well. So with the supports holding, we can definitely expect a pullback on Nifty. But if I were to compare both the indices, I think the one which is definitely currently looking a bit stronger is Bank Nifty, even at a current level of 47,400. For this sector and for this index, 46,800 spot is extremely important as a support. As long as it holds, you can see pullbacks to level of 48,400 as well. But in the next 15 days, if we happen to take out the swing high, which was made approximately around 49,900, then we might see a very fierce rally in Bank Nifty of around 2,000-3,000 points. But that happens to be too far from the current level. So I think we can talk about the support, which is 46,800, and the immediate resistance, which happens to be around 48,000, 48,200.
All right, FMCG still not a conviction buy, but you said that, one can look at the auto space. We had two numbers come in on Friday post market hours, Eicher Motors as well as the Tata Motors. Post numbers, how would you be playing into these stocks?
So I think if you look at the pre-open, Tata Motors is showing a slight negative pre-open and Eicher Motors is showing a flat one. I think both are doing well, and you may add something like a Maruti and TVS Motors to this. But given a choice, I think at lower levels, if we get Tata Motors around 980, 990, it would be a great pick. And you can definitely look at levels around 1050, 1065. So Tata Motors at this level looks good. And I think you can wait for a dip in Eicher Motors. Currently, it's quoting approximately 4,680, 4,700. If it dips to somewhere around 4,500 in the week going ahead, I think that can be a good level to enter this stock as well.
All right. Another stock that I want to get in your thoughts on is, Vijaya Diagnostic. It has seen a very good run over the last 5 sessions. Although today, in the pre-open, it is showing a weakish, some bit of a pause in the rally. But between Lalpath Labs and Vijaya Diagnostics, would you choose the latter?
Definitely, I think I'll go with you. If you look at the kind of structure which is formed in the last 3 days, so the price is increasing along with the volume, which shows conviction and also shows that strong hands have entered into this counter. So any dip in this counter, currently it's quoting around 802, pre-open shows around 790. But if we get this around 780, 785, it would be a great level to enter. I think there is a clear statement in the price itself of a convincing breakout. So you can look out for levels around 840, 850 as well.
ABB India, this stock will be in focus. Numbers have come out and numbers have been strong. All round beat. Profit has jumped somewhere around 87%. In terms of margins also, it has outperformed 18.5% vis-a-vis 11.5% on a YY basis. The stock, of course, in the pre-open, I can see a bump up of almost 5% or so. If somebody is looking at a fresh entry, would you advise? We have a query on a live feed from Debu K as well on this particular stock. What's the call here?
So I think I would not prefer chasing at this level. Definitely, it's a stock where you need to look at for a dip and an opportunity to enter on any and every dip. But where should the dip be? So currently, it's already showing somewhere around 7,550. My suggestion would be those who are holding can trail with levels around 7,400. It would be a very good level to book profits and wait for a dip. The dip may come somewhere as close to 7,000 would be a very good level to enter the stock for the next rally, which may take it to further levels around 7,800 or maybe even 8,000. But overall, if you look at this counter, it has hardly had any impact of the sluggish movement in the index. It has been doing on its own and showing great strength. Next thing to be noticed in this stock is every time the price has gone up, the volumes are picked up. So it is definitely a volume-backed price move, which can be trusted for sure.
All right, that's the view on ABB. Hold that thought, Prashant. We are just seconds away from the market open. We'll have to see how we open for the day, given the fact that GIFT Nifty is hinting at a lower start of somewhere around 40 basis point, 40 point rather, I beg your pardon, lower at the start. So in the pre-open, although markets are with a negative bias, but no big cut coming in. So the Nifty 22,000, is that level is holding on in the pre-open at least. But let's see how really we open up, because if you look at the global cues, which we have been ignoring for quite some time now, the Dow, Nasdaq and S&P 500 clocking their best week of 2024 last week. So globally cues are positive, but of course first tick has come, and Nifty of course opened with a negative bias, although the 22,000 mark is something that is holding on at the current juncture. The Nifty Bank Index very flat, although it is attempting to come back into the green. The mid and small cap indices also started with a negative bias, but no big cuts at the open at least. Aside of that, if you look at some of the sectoral movers, banks, as I mentioned, extremely flat, trading with a positive, in fact, a negative bias at the current juncture. Let's pull up the auto pack and see what the autos are doing this morning. Of course, we had big numbers coming in on Friday post market hours. So auto pack down over 1%. Let's also pull up the realty pack and see what it's doing. The realty pack was in focus. In fact, has seen some bit of profit booking as well last week. 0.2% lower for the realty pack. Pharma, that should come up next. And of course, Cipla, Dr. Reddy's, all of them reported numbers. In fact, Cipla is trading with a positive bias. In fact, 4% uptick, top Nifty gainer today. So the Nifty Pharma pack, drawing support from that, 0.5% up for the Nifty Pharma index. FMCG, that should come up on your screen next, because FMCG stocks have been witnessing buying action, and it extends its gain this Monday morning as well. 0.3% higher for the Nifty FMCG index. Advance decline ratio right now in favor of advances at the current juncture on the BSE. Let's see as the day progresses whether or not we manage to maintain this market breadth of 1:1 or not. Let's take a look at some of the top movers on the index then. Tata Motors, top Nifty loser. 5.5% lower for Tata Motors. Of course, is the JLR EBIT margin that seems to have disappointed. They have guided for a flat, margin for JLR for FY25. I think that is the big disappointment coming in, and the stock is clearly reacting to that. Eicher Motors down 1% among the losers, and so is BPCL. Hero Moto, another one, extending, some bit of losses here. Power Grid, JSW Steel, Bharti Airtel, which will be reporting its numbers this week, and M&M. These are some of the top laggards on the index. Even Reliance Industries is trading with a negative bias at the current juncture. In terms of gainers, you have Cipla. Management commentary on the Goa unit, is something that the street is taking heart from. It is expecting a resolution, on the Goa unit sometime this this financial year. Aside of that, UPL reports numbers today. Ahead of that, 3% higher. Sun Pharma, HDFC Life, Britannia, ITC. So yeah, some of the pharma and FMCG names providing support, but the Nifty has slipped below that 22,000 mark. 21,965 is where it's at the current juncture. Let's go back to Prashant. Then Prashant, looking at the open, how would you really position yourself in the FNO space? Any FNO strategies for the day for viewers?
So I think, as I had mentioned clearly, a sector which looks decent is metals, and any dip in this sector can be a good buy. You can look out for stocks like Tata Steel, where 155, 156 is a very good support level. Along with that, if you look out for auto, I think there is still an opportunity here. If you look at Tata Motors, 980, 975 was a good level, good support. Currently, it is holding. So my strategy would be, I would wait for somewhere near to the close, which is say around 315. And if the stock is still trading above 980, I'll definitely go long in this. I'll keep a stop loss at 960 and look out for targets which were the swing highs around 1050, 1045. So that would be my strategy. I would keep very few positions for the week going ahead, considering a high VIX and we are heading towards more volatility. So my positions would be less, stop losses would be small, and my quantities would also be small for the week ahead.
All right, that's the view. Those are the strategies. But talking about an Aarti Industries, it reported numbers, but over the last 1 month, the stock has been stuck in a downtrend. Although on a 6-month basis, it has done fairly well. Any crucial level that you'll be watching out for on the charts of Aarti Industries?
Yeah, definitely. I think the level which was formed, the low swing low of 650 holds a lot of importance. So if anyone wants to go long, the risk is low, but I would suggest going long in cash. You can keep stop losses around 645 and look out for targets somewhere around 718, 720 odd. I think that can be a good risk to reward in this stock. Overall, the sector has been doing relatively well, and the only thing is there has been profit booking at higher levels. It has not been able to sustain. You look at any of the stocks in the sector, but I feel in the year ahead, that is 2024 second half, this might be the sector to watch out.
All right. Of course, this might be the sector to watch out for. But Cipla, top Nifty gainer, what are the kind of levels you'll be working out with here? Up somewhere around 5%.
So I think it's a straight buy. It's a no-brainer for me accordingly. And one may even keep stop losses hardly around 1375, 1380 and look out to buy this stock. A crucial level happens to be 1440. If we cross that, I think you can straight see somewhere around 1500 as well on this stock.
All right, just one query that I want to address. Ashish Patel wants to know your thoughts on a Devyani International. All these QSR stocks, no big up move coming in on any of these stocks. Particularly for Devyani International, over the last 1 month, it has barely managed to give a 2% kind of a return, right? It's just coming off its 52-week lows. Any levels to watch out for here? Should one look at buying this stock at all?
So, Nandita, I would like to elaborate on a point here. In the year, if you compare from start of April last year till now, there have been a lot of stocks in this space, mid and small cap, which have gone 10x, 5x, 3x. It has been very normal to watch. And if you compare it with the Devyani, it is at the same price. So I think it has, if someone has been invested in this, it has been a lost opportunity. I think if you are specifically talking about this stock and interested in the stock, a crucial level is 145. So you can definitely invest with that kind of stop loss and the quantity. But if you ask me on a personal note, I prefer to buy stocks which are showing strength and outperforming the markets as against stocks which are showing weakness in an extremely strong bull market.
All right. And what about Reliance Industries? It was attempting to come off the recent weakness, but today, once again, it is among the top, 6, 7 losers on the index. At 2788, would you suggest getting in?
So my clear recommendation would be to not get into Reliance Industries unless and until it does not cross 2840, which is hardly a couple of 2-3% away from the current level. But if it crosses 2840, you can definitely get in with conviction. So instead of buying at lower levels and more of a hope kind of an investment, it's better to go in with a logical investment, which will be about 2840. Keep stop losses at 2800 or slightly lower, say 2795, and then you can look out for levels around 2900, 2950 as well. But 2840 happens to be a crucial level for this stock.
Right. I know you said that FMCG is not a buy at the current juncture, but for somebody holding on to a HUL or ITC, would you advise looking at booking their losses, or would you say that hang on and maybe for a couple of more months and see how things pan out going forward and then take a call?
No, I don't think ITC would be a loss for anyone. I think it has shown a good swing, and if anyone is holding ITC, you can comfortably keep positional stop losses at 415 and short-term stop losses around 425, 420 level between that. As far as HUL is concerned, I think this is one stock which has been a complete underperformer. And if this happens to cross 2400, which is currently trading around 2360 odd, so if it crosses 2400, I think then we might see a good steam in this stock, taking it to levels around 2500, maybe even 2700. So I think if I were to select between both of them, HUL about 2400 would be my pick.
All right, that's the view then. Let's just take up a few viewer queries that are trickling in then. Sudrashya wants to know your thoughts on whether Bank of Maharashtra warrants a fresh entry at the current juncture. Today it's down 2.5%. Even if you look at the last 5-day chart, it has shed somewhere around 6 to 7%. Would it give you a good entry point on dips?
So I think currently it's quoting around 62, 63, and a major support for this stock is around 58. So you can definitely add up quantities and hold till it does not close below 58. As long as 58 holds on a closing basis, you can comfortably look for pullback levels of around 70, 72.
All right, that's the view then. Hold that thought, Prashant. We'll come back and talk about specific stocks with you. Till then, let me bring on board our fundamental guest for today. Joining me is the big market voice that I promised earlier on in the show. Sunil Subramaniam, who is the MD and CEO of Sundaram Mutual Fund, is joining in. Sunil, as always, great to have you on the show. The recent volatility that we have seen in the market, of course, it is expected to continue till that 4th June event. But, of course, now policy continuity is something, that is a foregone conclusion. But if the incumbent government doesn't really come, win with a, majority or a comfortable majority, do you think we could be at risk for a deeper correction?
So I'm not so sure that it's as much related to the election results. I think that what's happened is that I think there's a lot of short-term money, hedge fund money, which has been coming into the market since December. And that was in post the assembly election results when there was clarity in the minds of the, poll experts that NDA would come back to power. There was no doubt about it. So while long-term money tends to come on this policy continuity, the short-term money which tends to play on that fact and wants to get in. The early bird gets the worm kind of a thought. They get in before the long-term money and they exit when they make their returns. And I think these have made very healthy returns from December. Now, normally I would have expected this kind of a thing, profit booking by these hedge funds to happen after the election. This time it's come a bit before, because I think that the low polling and a couple of other, experts saying that it doesn't look that strong, that, this ab ki baar 400 par, whether that will really happen. I think that uncertainty meant that these hedge funds have kind of decided to hedge their bets, right? And book their profits now rather than wait for the end result on 4th. So I think that's why you've had right from a month and a half FIs selling. It's largely the hedge fund profit booking. I don't see that as anything, it's a typical the way a hedge fund operates. They are speculative players who run a high risk, high reward game. They have leveraged. They're probably doing carry trade on yen and, borrowing. So I think that this will continue till the elections and maybe even post that, regardless of the results. So that's one. Yes, definitely, if the result is very, very bad or not as, as you say, single party majority is not coming through, which I still think that the probability of it is very, very low. But if that happens, definitely the markets will correct, because then some of the long-term money which had allocated a larger proportion to India could say, let's wait for a while, let the budget come out, let's see whether the coalition, if that's going to be a coalition, whether the pulls and pressures of a coalition alter the clear infrastructure capex and reform oriented objective of this government ever since they came to power 10 years ago. I think all of those factors would get revisited. But like I said, that's a low probability event in my mind. But I expect volatility to not stop with the elections. I think it will continue post the election till these hedge funds have, kind of run. And you remember that apart from the elections, right, it is an event heavy second half of the year. Right, there's the monsoon forecast which has to come out, actually the distribution of the rainfall, which is equally important, the RBI policy, the union budget, and then the big mother of them all is the US elections, right? So I think there's a lot of uncertainty, and oil prices are a key trigger to watch out for. I would say that post elections the oil prices will probably determine the level of volatility in India to a slightly greater degree than it is now.
All right, of course, quite a few events to watch out for that you pointed out, but one that I would like to really talk about is the earnings season, right? We've seen, more downgrades and upgrades, right? So what has been your biggest takeaway from the earnings that have come in so far? What are the big hits according to you, and what has been a big miss?
I think for us, the big hit has been, I think we've here, it's not just the results, right? It's also the guidance that the companies provide at the thing. And I think the consumption, the news that rural consumption is showing an uptake, you've had the FMCG companies talk positively. That's been the biggest uptake, because I think the overall scenario around, say, infra and IT has been the biggest disappointment in terms of there's talking very low single digit growth rates for the coming year. Which is definitely not a very good forecast for the sector, right? Infrastructure also, see, basically infrastructure stocks have been built up on the back of three legs of the capex story, right? The first is the government infrastructure capex. The second is the PLI, where the FDI flows coming in and setting up these factories, that driven capex. And third is the private sector actually expanding capacity. Now that's where there's been a stalling, right? You saw from a 60% levels capacity utilization due to consumption shoot up to about 73, 74 quite rapidly. But after that, there's been a tapering off of the growth path, and we are hung around 75. And the previous time when the Indian economy experienced a capex boom, the capacity utilization hit 80% plus. So I think that's a key trigger, and this consumption number gradually going up means that could come and give the trigger. So infra is the other space where, the numbers will not reflect yet, because it's all based on expected order book winning. So quarterly earnings obviously don't reflect the kind of a steep V-shaped EPS curve that we expect from infra companies. But there I think we should just display patience, right? Those numbers don't look as per expectation, but that's fine. That's because private capex is getting delayed. As and when that happens, right, the private capex, and I don't see really a challenge to that happening from medium term, because corporate debt is at about 50% of GDP, very low, so enough room to borrow. Corporate health is still good. You talk about downgrade, that's EPS downgrade, but credit quality wise, still almost 1.8 to 2 companies are getting upgraded compared to downgrade, and bank NPA levels are coming down. So overall, the situation to support a private sector expansion, all the nuts and bolts are in place. I think we have to wait for consumption to step up. and come get the capacity utilization to 80%, when you will see the next leg of the rally of that medium term infra play really come into play.
Right, but in anticipation of the consumption pickup, should one look at entering into some of these consumption names, because after the recent underperformance, are you finding valuation comfort there?
Not fully yet, but I would still say I would err on the side of increasing my consumption bets, because the beauty with the consumption pack is that there is a safety oriented FMCG play, and there's a high beta oriented consumer discretionary play. So by buying into the consumption pack, you are hedging your bets both in terms of safety and growth, and these are all linked to the banking sector. So I would say a combination of a banking plus consumption allocation would be able to give you both the safety plus the growth. I think it's, while they are not really cheap from a valuation perspective, but banking I think has been a decent amount of correction, so it's looking much better than a few months before.
So by banking, you mean private banks, right?
Yes, I would still favor the good quality private banks, because PSUs I think have run up a lot more in terms of the differential discount rather than a strong fundamental change in the way the PSU banks operate. But that doesn't mean I'm negative on PSU banks. I would just keep holding, because when the corporate capex cycle picks up, which again I'm coming back to, is the publisher banks which will have the leadership, because they are the ones who have the balance sheets and the risk-taking capability to lend 1,000, 5,000 crores to a corporate capex term loan, whereas private banks would still prefer retail as compared to corporate lending. So I would hold on to PSU banks. I'm not saying anything. I think that the rally has been quite sharp there.
Another question that I want to really ask you is about the defense pack. Of course, on a 3-year basis, some of these stocks have been multi-baggers, 3x, not 3x, I mean 10 to 15x kind of returns. But, we've recently had a couple of brokerages initiate coverage on these defense stocks. But would you not say that they are a little late to the party? Would you say they've already missed the bus?
No, I wouldn't say they've missed the bus. So what's happened there is that this government's Atmanirbhar initiative on defense, plus the fact that it's a huge employment generator, has been that the government focus was expected to come on this systematically, which has been happening. The stock market has run a bit ahead of itself in that place. Now, here again is where the election is important, because if the strong majority comes through and then the government continues on this Atmanirbhar, those numbers which the market has expected will turn out, and in fact they could turn out better. So in that case, if they actually turn out better, then you're not too late to the party. Yes, you joined a bit late, but doesn't mean you missed the bus. But if the government situation is not going to be that conducive, then I would say that in this context, right, defense is probably not a focused priority. Infra, building roads, employment generation overall, those are far bigger priorities for a government than to strengthen our defenses. So defense would still remain important from an import substitution perspective, because a lot of our defense requirements we highly import, and government's initiative would be to indigenize that as much as possible. So there will be growth in that space, but the quantum jump could be, if a strong majority comes, then that's a real focus area for growth. So depending on that, you can decide whether it's too late for the party or not.
All right, couple of more questions. And pharma as a pocket, how are you approaching this space? Because we've had numbers from Dr. Reddy's, Cipla. Of course, Dr. Reddy's, I think the US business has disappointed, in terms of a quarter-on-quarter growth, and the US launch pipeline also, isn't looking all that exciting at the current juncture. With Cipla, of course, the regulatory issues that are there, the resolution would be a key catalyst according to some analysts. So, would you play the pharma space through these drug makers, or would you look at diagnostic stocks or hospital stocks for that matter now?
I would prefer the diagnostic hospitals as far as that is concerned, clearly, because see, domestically the story of a higher penetration of insurance, the post-COVID awareness of health as a priority. I think a lot more people are going down, getting tested, hospitals. So I think the domestic story is on a decent wicket, and I would place my bets there. On the international oriented, I remain on the sidelines. So I would probably hug the benchmark. So to the extent that these stocks are a part of the benchmark, I would stay at around near that. I don't have a clear view on pharma in terms of it's so company specific, right? And I unfortunately can't talk specific companies. Right. It's a company specific view, but on a sector, I would try to remain at about the benchmark and not play my cards either way.
All right. Last question then. If we talk about premiumization as a theme, what are your thoughts on the entire travel and tourism space? Given the push towards spiritual tourism, would you look at this as a space? Hotels, for that matter, does this space excite you?
Hugely. I think it's not just spiritual tourism. I think even medical tourism, right? I think that's a big play. And I think that India's, whatever pharma leadership also plays in that. And I think that this government is very clear that, you see, when the infrastructure develops, these are the spin-off benefits. So smaller towns where the tourism potential is high get easily accessible. So I think that from a medium-term cycle, there's a secular bullish trend there. Definitely India's visibility in the world has gone up. Inbound tourism is definitely a big beneficiary. You can look at it from the airline prices and the hotel prices, even in smaller towns, are all closer to 8 to 10,000 rupees per night. So yes, I still think that there's a huge space for growth there. And what happens, the new hotels can't come up so easily. It takes 3 to 5 years to build up the whole, infrastructure for that. Like take Ayodhya, for example. The number of the land prices are shooting up 1,000% a year. So I think there's a huge untapped potential, but there will be these jumps, right? It's not a linear jump. Demand will go linearly, but supply can only come in steps. So there'll be huge supply and demand mismatches, which will lead to high pricing. And, so I think overall, from a market perspective, I think it's a good space to be in. Premiumization is definitely a big running story, because I think we are expecting India's per capita income itself, forget outside tourism, per capita income to be doubling by the end of the decade. So as people earn more, their need for basic necessities, basic dictionary items are the ones which are going to drive the consumption. And I see leisure, hotels, airlines, all of these as big plays in that space.
Right, last question really, Mr. Subramaniam. Of course, domestic flows have been a pillar for the market, right? And we've seen SIP flows top the 20,000 crore rupee mark for the first time ever. Is this the right time to, bump up your SIP allocation, your advice to investors?
Absolutely. I think that, see, India is going to get 1/5 of the global growth by the end of this decade is going to come from India. The Indian economic story, regardless of election results, right, is not going to be derailed by anything, because we have the demographic dividend to our advantage, a huge supply of labor. In the next 20 years, we are adding almost 15 crore people to our working age, whereas China is losing 11 crore. So it's a decisive advantage in favor of India. Whatever political formation comes to power will take advantage. And India's growth rate of this 6 to 7% that we are hovering around is nothing compared. I see the next decade we are actually going to touch 8 to 10% GDP growth with all these factors coming into play. So I think that, for a person who's looking at longer term investment potential, his earnings, most salaried class people get their income monthly. So SIP is absolutely the best way. And the beauty of it is short-term volatility because of the election news, oil prices, US elections. All of these give brilliant correction opportunities, and only a properly structured SIP plan can capture that rupee cost averaging benefit and now layer it with the power of compounding of the broader market. So I think absolutely, I say that to everybody. I mean, this is an excellent time to start or, even increase your SIP, from a longer term perspective.
All right. With that thought, Sunil, I would like to thank you for taking out time and joining in this morning and sharing your thoughts with us. It's always a pleasure chatting with you with so much, insights and advice for our investors.
Thank you.
Thank you. Well, with that, let's take a look at the market. The sell-off has deepened as we speak. I mean, 160 point cut on the index. We have slipped even below that 21,900 mark. The big laggard on the index, of course, is Tata Motors, down 8%. BPCL, JSW Steel, Hero MotoCorp, Tata Steel. So entire auto and metal pack seems to be under pressure, and so is the oil and gas pack. ONGC among the top Nifty losers. On the flip side, just a handful of gainers. Cipla, HDFC Life, UPL, Eicher Motors and Britannia. These are some of the gainers, but Cipla is holding on to the gains. 5.5% gain coming in there. But, the cut is, of course, deeper across the broader end of the markets. Pull up the Nifty mid-cap index. That's down 1.5%. I think the Nifty small-cap index is equally, under pressure. And the Nifty bank index, just below that 47,200 mark now. 0.5% cut coming in there as well. Some of the other notable names that I want to point out are the likes of SBI, heavyweight down 1.5%, Hindalco, Power Grid, Titan, Maruti, most of these large cap names are under pressure. Do we have a technical expert? Can we go to him? All right, we don't have a technical expert, but of course, right now it's not looking pretty. If you look at the screen, you have, a sea of red with the Nifty below that 21,900 mark. Of course, we'll have to see as the day progresses where, we manage to settle for the day. But of course, we also have a new listing at 10 a.m. Indegene. The issue price was somewhere around, 430 to 452 rupees a piece. The grey market premium was indicating at a listing price of somewhere around 700 rupees or thereabouts. That's a 65% premium to its issue price. Of course, keep an eye out for that as well. But of course, our technical expert is not there with us at the current juncture, so we'll not be able to take up more queries. But I can see some comments on why people are confused as to why Tata Motors is down so much. Let me take you through the numbers. Of course, profit was a beat on the back of tax credit. Revenue was in line with estimates. Margin, in fact, was slightly below, and it's the EBIT margin guidance for JLR that seems to have disappointed Street. They have said that EBIT margin for FY25 will remain flat vis-a-vis FY24, and that I think has come as a big disappointment. But with that, we are completely timed out on this edition of Opening Bell. Of course, keep your queries coming in. Today we couldn't take a lot of them, but tomorrow we will try and take as many as possible. So don't get disheartened. We will address your queries. Of course, keep them coming in. But for now, of course, not looking great when it comes to the stock markets. Let's see how things pan out. But for now, from me and the entire team, thanks a lot for tuning in. You guys stay tuned to Money Control for all your other news and updates.